The 2025 housing crash isn't a prediction anymore. It's a full-blown disaster unfolding in real time. Across America, once booming cities are now drowning in listings, price cuts, and desperate sellers. Home values are collapsing by 60% or more, and the fallout is worse than 2008. Builders are panicking, buyers have vanished, and investors are racing to dump properties before the market implodes. From desert suburbs to coastal retreats, no region is safe. Equity is vanishing overnight, and mortgage payments are crushing families. These 10 housing markets are the epicenters of the collapse, and the pain is just getting started. Number 10. Reno, Nevada. Once hailed as the next big thing in Western real estate, Reno's boomtown fantasy is turning into a nightmare for homeowners and investors alike. Between 2020 and early 2022, Reno's median home price surged from around $375,000 to nearly $615,000, an eye-watering 64% increase in just 2 years. But in 2025, that meteoric rise is backfiring hard. With rising interest rates, reduced affordability, and investor pullback, Reno now sits at the edge of a massive housing cliff, one that could see prices plunge by 60% or more. The biggest red flag? Reno is grossly overbuilt. New housing developments, especially in suburban areas like Spanish Springs and De Monte Ranch, flooded the market during the pandemic buying frenzy. Builders kept hammering through 2023 and 2024, even as demand cooled. Now, that inventory glut is haunting the market. Homes are sitting longer, average days on market has tripled compared to 2022, and sellers are slashing prices by $50,000 to $100,000 just to get attention. Meanwhile, affordability has collapsed. With mortgage rates hovering around 7%, the monthly payment on a median-priced home in Reno now exceeds $4,000, including taxes and insurance. That's simply out of reach for most working-class residents, especially those employed in Reno's hospitality and light tech sectors. Many buyers are backing out, and pending sales have dropped over 40% since late 2024. Reno also became a magnet for California transplants during the pandemic, pushing prices up rapidly. But in 2025, that wave has receded. Californians are no longer buying in droves, and many are trying to sell off second homes or rental properties they scooped up in Reno just a few years ago. Investors are retreating fast, turning potential equity gains into panic listings. If the correction continues, and all signs say it will, Reno could see a drop back to sub-$250,000 levels, wiping out nearly all equity gains made since 2020. For some over-leveraged buyers and flippers, it's déjà vu from 2008. But worse, Reno's high-stakes housing game now comes with devastating losses. Number 9. La Jolla, California. La Jolla, one of California's most prestigious coastal gems, is staring down a real estate reckoning no one saw coming. This isn't your average housing market, it's ultra-luxury. But even million-dollar ZIP codes aren't immune when the economic tide turns. La Jolla's median home prices soared to over $2.6 million during the peak frenzy of 2021 to 2022. That's nearly double from pre-pandemic levels when high-end homes hovered around $1.4 million. But in 2025, demand has dried up, listings are stacking, and price cuts are slicing through this posh neighborhood like a hot knife through butter. What's the issue? Liquidity. These aren't homes people buy to live in. Many were second homes, vacation properties, or speculative luxury investments. Now, high mortgage rates, an evaporating pool of wealthy buyers, and global uncertainty are driving sellers to panic. Homes once valued at $4 to $5 million are being slashed by $800,000 to $1.2 million just to attract offers. Some luxury condos have seen a 40% drop already, and we're just getting started. Another challenge: buyers in this tier are ultra-sensitive to stock market swings. With Wall Street wobbling in 2025 and fewer IPOs minting millionaires, the fountain of wealth that fed La Jolla's boom has dried up. Pair that with rising property taxes, insurance premiums, and tighter lending standards, and even high-net-worth individuals are hesitating. open houses in La Jolla are quieter than ever. Days on market has more than doubled, and agents whisper that nothing is moving unless it's underpriced. If the downturn accelerates, La Jolla could see values crater 60% or more, especially on oversized estates that cost a fortune to maintain. In the land of dream homes with ocean views, reality is crashing down like a rogue wave, and fast. Number 8. Naples, Florida. Naples has long been Florida's crown jewel of coastal luxury, a place where beachfront condos sell for millions and retirees park their yachts beside waterfront mansions. But in 2025, this ultra-prime market is quietly unraveling. During the post-pandemic buying frenzy, median home prices in Naples exploded from $430,000 in 2020 to over $850,000 by 2020, mid-2022. That's nearly a 100% increase in just 2 years. But like every bubble, this one has started leaking, badly. The danger with Naples lies in its fragility. Much of the buying here came from out-of-state retirees, snowbirds, and cash-flush investors chasing lifestyle over logic. Many bought at the top, expecting endless appreciation. But now, with soaring insurance premiums, especially for flood-prone areas, and stricter hurricane-proofing codes, costs are choking even wealthy homeowners. In some cases, annual insurance alone has shot past $15,000 to $20,000. Meanwhile, homes are sitting longer. Listings have piled up, and agents report buyers are vanishing, especially for properties above the $1.5 million mark. Price cuts of 20 to 30% are already visible, and luxury condos are facing an inventory tsunami. With climate risks rising, new FEMA flood maps, and higher HOA fees for aging buildings, Naples is losing its once untouchable appeal. What's worse, many retirees are now looking elsewhere: Alabama, the Carolinas, even Tennessee, where they can enjoy similar weather without paying $500,000 for a modest house. That means Naples' demand pool is shrinking while supply keeps climbing. If current trends continue, some homes in Naples could see price drops of 60% or more, especially those far from the beach but still priced like oceanfront property. For those who bought near the top, the Florida dream may turn into an expensive and soggy financial nightmare. Number 7. Bakersfield, California. Bakersfield was never supposed to be glamorous, but it was affordable. That's what made it so attractive during the 2020 to 2022 housing boom. People fled the expensive chaos of Los Angeles and the Bay Area, and Bakersfield welcomed them with open arms and open land. Home prices shot from around $240,000 in 2019 to nearly $440,000 by 2020-2022. But now, in 2025, Bakersfield is in serious trouble, with prices tumbling and buyers vanishing. The biggest red flag? Affordability has collapsed. Incomes in Bakersfield haven't kept up. While housing prices nearly doubled, wages in local industries, mostly oil, agriculture, and logistics, remained flat. That gap created a fragile market dependent on outside buyers. But with interest rates still hovering around 7%, a median home now comes with a mortgage of over $3,200 a month, far too steep for local families. Investors were everywhere during the boom. At one point, nearly 1 in 4 homes was being bought by an investor or flipper, hoping for quick appreciation. That strategy is now backfiring. Many of those homes are being dumped onto the market at discounts of $50,000 to $100,000 just to avoid deeper losses. Newer developments on the city's outskirts are faring even worse, where builders are offering steep incentives and dragging down resale values. Foreclosures are also ticking upward, especially from buyers who stretched to buy with adjustable rate mortgages in 2021 to 2022. As those rates reset, payments are jumping by hundreds, and delinquencies are quietly rising behind the scenes. If inventory keeps swelling and local wages remain stagnant, Bakersfield could easily see home values collapse by 60%, bringing them back to pre-2016 levels. It's déjà vu from the 2008 crash, but this time it's not subprime loans. It's the simple math of unsustainable prices and no one left to pay the bill. Number 6. Las Vegas, Nevada. Las Vegas thrives on risk, but this time the house is losing. After a wild pandemic-era boom, the Vegas housing market is collapsing faster than a busted flush. From 2020 to early 2022, median home prices in Las Vegas shot from $290,000 to over $460,000, a 58% spike driven by remote workers, out-of-state investors, and dirt-cheap interest rates. But by 2025, the cards have turned, and Vegas is heading for a housing bust that could rival 2008. Inventory is ballooning. The number of active listings has more than doubled in the past year. Homes that once sold in a weekend now sit for 3 to 4 months. Price reductions are everywhere. Over 40% of all listings are now being discounted, many by $50,000 to $150,000. The culprit? Overbuilding and overspeculating. Thousands of new homes went up across suburbs like Summerlin and Henderson, targeting middle-class Californians and investors who believed the Vegas boom would last forever. But now, that investor class is liquidating. Rents are dropping. Airbnb income has dried up. Mortgage rates over 7% have turned Vegas homes from hot commodities into dead weight. Even worse, local wages never justified the price run-up. Las Vegas still relies heavily on tourism, hospitality, and entertainment jobs, many of which haven't returned to pre-COVID strength. That makes the market highly sensitive to economic slowdowns. If current conditions persist, analysts expect home values could fall back to pre-2015 levels, meaning a 60% plus correction is absolutely on the table. In Las Vegas, the real estate dream turned out to be just another illusion, now melting under the heat of higher rates, weak demand, and too much supply. Number 5. Palm Bay, Florida. Palm Bay isn't flashy like Miami or Tampa. It's a quiet city on Florida's East Coast, best known for being affordable, until it wasn't. Between 2020 and 2022, Palm Bay's median home price jumped from $190,000 to $370,000, a shocking 95% increase. That boom was fueled by pandemic migration, remote workers, and flippers trying to make a quick buck in a sleepy market. But in 2025, Palm Bay's crash is quietly becoming one of Florida's worst. The warning signs are everywhere. Inventory has exploded, and price cuts have become standard. Homes listed at $400,000 last year are now being slashed to $300,000 or less, and still sitting. Builders continue flooding the market with new homes, offering incentives like $20,000 discounts and interest rate buydowns, dragging resale values even lower. Palm Bay's biggest vulnerability is its dependence on speculative demand. Most buyers during the boom weren't locals. They were remote workers, cash-rich retirees, or investors betting on long-term growth. But now, those buyers have vanished, and many are trying to offload before prices sink further. Meanwhile, rents are softening, and investor landlords are bailing. Affordability is another issue. With interest rates stuck above 7%, the average monthly payment on a median-priced home exceeds $2,800, far above what most local families can manage. And unlike Miami or Orlando, Palm Bay doesn't have a deep employment base to prop up prices. The job market is thin, and economic activity is slowing. If current conditions worsen, Palm Bay could see a 60 to 65% price collapse, bringing median prices back to $150,000 territory, where they were before the boom. It may not grab national headlines, but Palm Bay is quietly sinking into the quicksand of Florida's housing bust, one painful price cut at a time. Number 4. Stockton, California. Stockton has seen this movie before. After getting crushed in the 2008 housing crash, the city rebuilt slowly, until COVID hit. Then, prices took off again. From 2019 to 2022, median home values in Stockton surged from $310,000 to over $550,000, driven by Bay Area residents fleeing high costs. But in 2025, Stockton is once again a cautionary tale, this time with even bigger stakes. The warning signs are flashing red. Inventory is up nearly 90% year over year, and pending sales have collapsed. Over 50% of listings are cutting prices, often by $75,000 to $125,000, and homes still sit unsold for months. Why? because Stockton's demand was artificial. Most of the price surge came from out-of-town buyers, not local wage earners. Now that remote work is fading and Bay Area affordability is slightly improving, those migrants are gone, and the investors who followed them are bailing out. Some neighborhoods, especially in South and East Stockton, are already seeing price drops of 35 to 40%, with more to come. Foreclosures are creeping back in too. Many families bought at the peak with low down payments, betting prices would keep rising. Now, with negative equity setting in and rising insurance and tax bills, some are walking away. Builders in Lodi and outskirts of Stockton are offering huge discounts, up to $100,000, which further undercuts resale value. Stockton is also facing a crime and infrastructure crisis that's pushing buyers away. People who moved in for affordability are now questioning if it was worth it. If this snowball keeps rolling, Stockton could lose 60% of its pandemic-era gains, resetting values below $250,000. That's not just a correction. That's a second crash. Stockton is once again proving that when it comes to real estate, what booms hardest often busts worst. Number 3. Austin, Texas. Austin used to be the darling of America's housing market, young, hip, and exploding with tech jobs. But in 2025, the music is fading fast. Between 2020 and mid-2022, Austin's median home price skyrocketed from $340,000 to over $670,000, a jaw-dropping 97% increase. That red-hot growth made it one of the fastest appreciating markets in the US, but it also created one of the most vulnerable bubbles. Today, home values are collapsing under their own weight. The biggest problem? Austin's surge wasn't built on local income. It was driven by Silicon Valley transplants, startup IPO cash, and investor frenzy. Now that tech layoffs are sweeping the nation, IPO pipelines are frozen, and venture capital is drying up. Austin's buyer pool is shrinking by the day. Meanwhile, builders went overboard. Suburbs like Leander, Buda, and Kyle are drowning in new construction. Builders are slashing prices by $50,000 to $120,000, offering free appliances, and even covering closing costs just to move inventory. That's crushing the resale market and forcing homeowners who bought near the top to slash prices or accept huge losses. Affordability is another killer. Mortgage rates above 7% have pushed monthly payments on a median home to over $4,200, which is way out of reach for most local workers. Rental yields have dropped, and short-term rental oversupply has led many investors to panic sell. As of mid-2025, prices in some neighborhoods have already dropped by 35 to 45%, with more pain ahead. If trends continue, a 60% correction is highly possible, returning values to 2017 to 2018 levels. For a city that once symbolized the future of real estate, Austin is now a painful reminder that when speculation replaces fundamentals, even boomtowns can go bust hard and fast. Number 2. Cape Coral, Florida. Cape Coral, once dubbed Florida's last affordable waterfront paradise, is now at the center of the state's housing nightmare. During the pandemic, prices exploded. The median home price shot up from around $230,000 in 2020 to over $470,000 in 2022, a more than 100% increase in just 2 years. But in 2025, Cape Coral's housing market is falling apart, fast and hard. The area saw massive overbuilding. Developers flooded the region with thousands of new homes, confident demand would last forever. Now, many of those homes sit empty while builders are offering $60,000 plus discounts, rate buydowns, and even paying insurance premiums to lure hesitant buyers. But nothing's working. Buyers are gone. Cape Coral is also suffering from skyrocketing homeowners, insurance costs due to increasing flood risk and tighter building codes after Hurricane Ian's devastation. Insurance premiums have more than doubled, with some policies exceeding $9,000 annually, making even modest homes unaffordable for average Floridians. At the same time, property taxes are rising, HOAs are demanding bigger reserves, and buyers are waking up to the hidden costs of owning here. That's triggering an exodus of retirees and investors, especially those who bought rental properties at inflated prices. The result? Listings are soaring. Inventory is 3 times higher than in 2022, and over 50% of homes on the market have seen price cuts. Days on market have doubled, and many sellers are chasing the market down, hoping to sell before deeper losses hit. If current pressures continue, Cape Coral could easily see home prices fall back to under $200,000, marking a 60% or greater collapse. What was once marketed as a Florida dream now feels like a ticking financial time bomb, where paradise isn't just lost, it's being foreclosed one listing at a time. Number 1. Phoenix, Arizona. Phoenix isn't just in a housing downturn. It's becoming ground zero for the 2025 housing collapse. Few cities match the explosive growth Phoenix saw during the COVID housing boom. Between 2019 and 2022, the median home price soared from $280,000 to nearly $510,000, a staggering 82% increase. But what goes up fast in real estate usually comes crashing down harder, and Phoenix is already tumbling headfirst. By 2025, the cracks have become chasms. Inventory has quadrupled, and over 55% of listings now feature price reductions, some by $100,000 or more. Homes that once sold in bidding wars now sit for 90 to 120 days as demand dries up and investors race for the exits. Phoenix was flooded with investors during the boom, especially iBuyers and institutional landlords who bought thousands of homes, often sight unseen. Many of those homes are now underwater. With rents falling and mortgage costs rising, the math doesn't work anymore. Some investors are dumping properties at fire sale prices just to cut their losses. At the same time, Phoenix locals are being priced out. With interest rates above 7%, the monthly cost to buy a median-priced home is now over $3,800, while average household incomes haven't kept pace. Many buyers have simply given up. Another pressure point is overbuilding. The city's outskirts, like Buckeye, Queen Creek, and Maricopa, are littered with half-empty subdivisions. Builders are offering massive incentives, dragging down comps in the process. Foreclosures are rising again, especially among buyers who stretched with low down payments. Even FHA-backed loans are starting to default, signaling deeper trouble ahead. Experts say Phoenix could face a 60% price collapse, returning home values to pre-2015 levels. In many ways, it's déjà vu from 2008, but even more dangerous because this time the overvaluation is broader and the economic headwinds stronger. Phoenix isn't just falling, it's leading the crash.